Good morning. This is Ken Long from Tortoise Capital with a review of the weekend trading report for March 29th, 2015. Market is in bullish normal conditions on an annual basis using weekly RSI 14. It's in the middle of neutral at 54 out of 100. On a 10-day basis using the 10-day NDX, it's at the low end of neutral with a score of 23 out of 100. The boundary to oversold on that is 20. Looking at the market mosaic, price relative to the 200-day moving average is red bullish at 3.23%, so only 1.25% cushion between price and sideways market conditions. ADX 14 remains neutral at 17.8, so no trend. Slope of the 50 is yellow neutral, also no trend. The risk index is the 30-period moving average of the VIX divided by the 10-period moving average of the VIX. The threshold between risk on and risk off is 1.0. Current reading is at 1.01, so we are just slightly into risk on conditions. If you take that score of 1.01 and compare it to the last 5,000 trading days, find the average and standard deviation and compute the Z-score, we come up with the risk Z, which is currently at 0.09. This indicator shows the last 90 days of the risk Z. You can see it's just nudging into the green here slightly after a pullback from a Z-score in excess of 2. This was that most recent weakness, but showing some signs of stability here. We'll be redoing the blended monthly rebalancing next week on or about 1 April. These are the current holdings, and then these are the leaders based on the close as of Friday. And then these are the leaders on these other populations of large caps and then ETFs as well, as a way to identify some relative strength leaders. In ETF 2, the theoretical exposure is at 80%. The model portfolio is also at 80%. It just cashed a position in XBI, which pulled back sharply from its all-time high. Our Kansas City workshop has 18 attendees so far. Still time to join. And that's scheduled from 5 to 12 June. Send me an email at longke@yahoo.com if interested in more details. These are the current holdings for the blended monthly rebalancing for the ETF 13 and ETF 32 portfolios. You can see the 32 is mixed between buy and cash signals, Japan treasuries, and then healthcare at the top on the 32, and then mid caps and U.S. real estate in ETF 13. Latin America is still continuing to lag. This is ETF Max. This is about 1,200 ETFs with the leaders identified here. The ones I'm really interested in are the green and white. These are ones that are early in their life cycle of expansion, if you will. So TAN is up 32% in 3 months, but only up 2% over 6 months, so it has recovered a nice move. Also, clean energy, solar, you can see the trend here. AccuVest Global Long Short. Now, the ones that are white and green, like this one, EDV, that's one where the shorter term performance is starting to really lag. The Russell for Japan is of interest. This is an Asian topics, more Japan, Nikkei, so you can see the trend there. Again, it's looking a little like Japan and Asia, less Japan, are starting to recover. This is the S&P 500 top 40 or so, and includes the sector spider that they are members of. So Hospira has been on the list for quite a long time. Urban Outfitters is relatively new. Kohl's. First Solar is really, FSLR should be of great interest. It's down 16% over 6 months, but up 35% over 3 months, so quite a rebound there in the solar space. This is the market health check. The vertical blue lines represent 10, 20, and 30 days worth of look back. The horizontal purple line is the price target beyond which we really have to see price gains in order to be confident in this bull. The horizontal red lines are price levels that were once resistance and are now support. Were priced to fail, then we would be using those as price targets on the way down. And then they are resistance or price targets on the way back up. We're currently in the yellow zone, which is where I'm going in the direction of the daily market move, waiting to see the directionality. If it gets back above the dragon here around 209, then I would be looking to be long by default. If it falls out of the floodplain here at about 204-ish, then I would be looking with a daily short bias. Currently the slope of the 30 is negative, as you can see across the dotted line here, and is now down around minus 1.2. This is still a routine pullback. It's not until it gets down below minus 0.22 on slope that it becomes a statistically challenging downslope. The dark blue shaded area is the river. That's 30-period Bollinger Band plus or minus 1. Floodplain is 30-period Bollinger Band plus or minus 2. The dragon is this pink ribbon in the middle. That's a 10-period Bollinger Band plus or minus 0.5. You'll notice he's comfortably resting here at the bottom of the river. Notice that this period, after this extension right here, slope had gotten up around 0.4, which is extremely steep up, and the dragon had completely out of the river. Two PSAR dots on the other side, and the dragon rolling over is a warning to lock in the profits of that move, which was timely warning indeed. And we're now down below the zero line on the slope. So the black line is in the center is the 30-period regression line, lagged by a day. The outer channel formed by the maximum excursion during the look-back period. The blue lines are the same channel, the RAF regression channel for the 10-period. You see both sloping downward. You can see the rising 200-day moving average here. So this aging bull is still not firing on all cylinders. We'd be looking for this support level to hold. If we have some belief that this bull trend is going to continue, then we've got to see some support roughly in the area we are right now in order to get the slope turned around in time. Strong support here at 200, which would be right on the boundary of that 200-day moving average as well. You can see we are just almost oversold here. The jaws of PPO were open to the downside after this last leg down, when there's a brief flirting with up, but now it's rolled over and opening to the downside. ETF2 regional report, 2 out of 8 of the indexes are on cash signal, so that puts us at 80-20 for the allocation strategy generic, and then down from 90-10. Bull normal conditions. Right now, EFA at 69 strength is better than the S&P at 67 strength. Inside the U.S., it's mid caps, then small caps, then technology, then large caps. An inversion of last year's order of strength. Two strongest sectors right now are Japan and the U.S. mid caps at 71. Two weakest sectors are Latin America at 53 and emerging markets at 64. Only healthcare remains really strong among the U.S. indexes. The above average ones, technology, staples, and discretionary. Still weakness here in energy, financials, industrials. World market model, everything in the U.S. above average, but nothing in the green. Japan in the green, India and Philippines in the green, Vietnam, Latin America, Brazil, oil, commodities in the red, all of Europe above average. These are the ETF top 30 using the ETF2 methodology. You can see biotech, United Health, biotech, home construction still looking good. These that are green and then white are relatively new to the table. You see a lot of non-U.S. members in there. Hedged equity for EFA, Japan, the dollar bull, 10-period Bollinger Band plus or minus 2. The 30-period Bollinger Band plus or minus 0.5. Bull normal conditions. Right now, EFA at 69 strength is better than the S&P at 67 strength. Inside the U.S., it's mid caps, then small caps, then technology, then large caps. A lot of non-U.S. members in there. Hedged equity for EFA, U.S. retail sector spider for healthcare still very strong. Philippines, more real estate, etc. This is the same lens now looking at the Dow. See, we have quite a few more now in the red, whereas even 4 months ago this was predominantly green and white. Strength here in the top four: United Health, Boeing, Home Depot, Disney. Weakening here in Walmart with the yellow and white, along with DuPont and JP Morgan. Yellow and white are weakening. These that are red and yellow are also recently weakening, and near the bottom of the stack, Procter and Gamble down through Microsoft. And then the two that have really been suffering the most, Alcoa and Caterpillar. Just for reference, ETF liquidity based on daily dollar volume, the top 30 in terms of dollars traded. Shifting to the daily report, quite a few symbols to choose from various swing strategies and the auto framer. See the volatility has come back into the market, leveling off here around the 6-month average. Many to choose from in the auto framer that are better than 2 to 1. Quite a few of our favorite swing patterns as well. Channeling, overreaction, some 5 days down, a 551W, and then a bunch of auto framers. A half a dozen that fire on the RSI2 score as well. So DuPont should be on our short list here. It was a doji. Channeling and overreaction, it's number 1 max pain range compression, 7.8 to 1 on the auto framer. It was not a big loser on Friday, so that's where that doji comes from. Maybe that's the turning point, and scores 2 on the RSI2, so that's a chart worth looking at. Almost the same story here in the ETFs. Some overreactions, a 5-day down in finance, 551W in the small caps, Russell. 4 fire in the RSI2. XIV, the inverse of the VIX, had a good day and a good 10 days and a good 1 month. So XIV should be on our radar as well. Brazil continues to be a target of interest in both directions. 2.5 to 1 on the auto framer. It's a 7 on RSI2 and had a big day down Friday, so looking for more weakness there. Just for reference, the auto framer and the RLFF concept, these are various targets on those methodologies. And that's everything I want to cover for this executive summary of the weekend reports. We'll see you at the chat room tonight. Thanks for your kind attention. Come on out and visit us in Kansas City. Eat some good barbecue and good networking with our traders. This is Ken Long from Tortoise Capital. Keep your risk measured and your powder dry. Good trading.